Good morning to our wonderful audience and welcome back to Boutiques on Wednesdays. It is simply wonderful to have you all back with us. From the BCI team, we extend our best wishes for 2023 and may you have a very blessed and prosperous year. As at the end of December 2022, our AOA is sitting at 275 billion. And this is all thanks to your continued support and the great work done by our 130 boutique manager partners. We remain immensely grateful. Just a short reminder to register for our February half-day live sessions, 15 February in Pretoria, 17 February in Johannesburg, and 22 Feb in Cape Town. Again, these sessions are not hybrid sessions, they are live sessions. The last few months of 2022 gave investors some relief as it appears as we move past peak inflation, but there's a lot more work to be done. The drop in US inflation from 7.1% to 6.45% is significant, but we're a long way off from the 2% target rate. As a result, we've seen a slowing in the US dollar, and this should benefit emerging markets like South Africa and China. We will see more rate hikes, definitely, but at a slower rate, with continued talks about recession in major developed markets. And we've seen the World Bank downgrade the US economic growth forecast for 2023 to a mere 0.5%. With all other economies overheating and China being counter-cyclical, is it then not time to consider increasing exposure to faster growing economies like China at historically low valuations at the moment? But then, what about China's policy reform and the huge surge recently in BF7 deaths? Could China see a reversal on the zero COVID policy reversal? It's reported 900 million people in China are infected. Is there another economic shutdown in China looming? Who knows? Joining us now all the way from RisCura, from London, it's Business Development Manager Lars Helgenbuch, and all the way from Hong Kong, investment analyst Robin Yu, to share the views on the China and how investment opportunities come together in the RisCura BCI China Equity Feeder Fund. Robin and Lars, it's an absolute privilege for you to join us very early on your side, so thank you for your time. There's a lot of talk among a lot of people on how China is a great investment opportunity at the moment. We're really looking forward to your introduction to RisCura and your business, how you set up, where you fit in, and then specifically our topic this morning, your China Equity Fund and how you can give clients access to this market opportunity.
Thanks so much, Eugene. Luckily, we don't share entirely your pessimism there on what's going on in China. But hopefully, we'll spend the next half an hour or so talking you guys through the opportunities and why we think really right now is the inflection point. The train is about to leave the station. You want to be on that train. So hopefully, we'll give you that as a takeaway in the next half hour. I'm going to share my screen now.
Yeah.
For some reason that's not coming through here.
Yeah, I'll tell you when it comes through.
Give me a second. Right, there we go.
Yeah, it's starting to share.
Okay, so
Here we go, perfect.
Let me introduce RisCura a little bit to you guys, because we're more well known as an advisory firm in the South African institutional pensions market. We have about $165 billion under advice, including more than $1 billion to China. But what's really exciting is that we've encapsulated that capability, that manager research and macro capability into a series of pooled funds, which now actually with market movements, it's more than $850 million in total that we have in various pooled fund of funds allocating to China. We have people in Hong Kong and Shanghai, and my colleague Robin Yu is our lead investment researcher out in Hong Kong, so he'll be helping me talk you through the things that are going on out there in that market. So Just a brief background to those of you a little bit less familiar with the Chinese market. It's grown very, very rapidly over the last 15 years. Markets were originally reopened in the early 90s, but it's really since the mid-2000s that market has exploded. More than 6,500 companies listed. It's the second largest in the world after the US, and with very, very high turnover, which is largely attributable to retail investors, which is a great characteristic if you are a professional institutional investor, because on average, a retail investor is likely to be less skillful and less knowledgeable than a pro. The economy, as Eugene already indicated, is one of the places where there still has been growth in the last couple of years. But we would argue that going forward, the sources of that growth are likely to be a little bit different. We've highlighted two in the top left side of this chart. That's the supply chain inwardization, where basically the Chinese have made it a policy priority to wean themselves off Western suppliers for particularly high-tech goods, semiconductors, AI, all those sort of things. So there's large investment and support for companies operating in those sectors, which creates opportunities for investors. And the other key theme for the Chinese over the next couple of decades is the green economy. China has committed itself to net zero by 2060. And with that comes huge investment in electric cars, battery manufacturing, solar panels, wind turbines. The Chinese are the biggest manufacturers already of all three of those categories. So there's policy support for the green economy, which in turn gives investment opportunities. And the final one, just to point out at the bottom, what's also been a big factor in that economy over the last decade or so is a swap from being quantity-driven to quality-driven. So no longer just a manufacturing center for cheap iPhones and iPads, but actually making high quality goods for the domestic market, high quality goods for export. As Eugene said, China is an uncorrelated investment for a globally diversified portfolio. This is the rolling correlation between the MSCI World and the China Mainland Index. As you can see, it varies from strongly negative to strongly positive throughout time. So China very much has a reputation as, I wouldn't necessarily say counter-cyclical, but it just does its own thing. So there will be times where it follows the US and the rest of the world, and times where it is completely different. So it's a very, very good diversifier in a wide ranging portfolio. I spoke about the retail investors. They actually make up more than half of the ownership of the mainland shares, the A shares on the Shanghai and Shenzhen stock markets. And like I said, they're not known for being efficient in their pricing. They will create substantial active management opportunity. And we would certainly argue that to access the Chinese market, to get the main benefit from the Chinese market, you need to be in an actively managed portfolio, not in some type of index fund or passive portfolio. That characteristic is amplified by the lack of broker coverage or analyst coverage. If you look at the chart on the left-hand side, more than 2,500 or almost 2,500 at least of the more than 6,000 companies on that market have no analysts covering them whatsoever. There's no broker, there's no report you can read, there's no quantitative screening you can do for those companies. So it's ripe for a professional. But the downside of that, of course, is that you have to do a lot more work yourself. So if you are going to be a professional investor, then you need to almost act like a private equity guy. You need to do the work with financial statements, with meeting management, much more so than you would in say, a Western market, because there is just no help that you're going to get from the broker community. And one consequence of that is that Chinese asset managers typically run quite concentrated portfolios. You can only do research really well on, maybe 100 companies, you can research 50 of them, you can get to know 20 of them extremely well. That's as much as you can manage with the typical resources in an asset management firm. And so they're very concentrated, which means that a multi-manager approach becomes quite important in China. If you want to cover the waterfront of opportunities, you need to have several managers in your portfolio, each looking at, say, a different subsector or different industry, different geographical region. So the size of the market, the challenge of the stock level research make it really important to get lots of managers into your portfolio. And to capture this, you need local expertise. right? In order to find the right managers, to find the right opportunities, it really, really makes a big difference to be based domestically, to have a team on site in country, as opposed to just trying to make your investments from Johannesburg or from New York and never actually go into China. Okay, I'm going to hand over to Robin to really talk us through what we call the is China investable question. As Eugene said, China has not been without its issues over the last 18 months. Our message really is that the turning point is upon us. You need to be on it. Robin.
Thank you, Lars. My name is Robin. I'm the China analyst at RisCura. Thank you very much for joining us today. The question that we have been hearing from investors over the last years is China investable? Our conclusion is yes, it's definitely investable, and we even argue for that. China should be a very important part of one's global portfolio. And I remember we were on a roadshow in mid-October, and at that time the market sentiment was so low towards China because it was basically a perfect storm of negative events that happened in the past 2 years. We were very excited about the opportunity at that time because valuations are so low. We think the market is more than pricing in all the risks, and we remain constructive on a lot of the growth opportunity in China. And over the past 2 months, the market have became much more positive towards the future, and we think there's still a long way to go in terms of first recovery and then get on the next stage of growth opportunity. On this slide, really we want to point out that global investors already have China exposure in the portfolios, whether it's direct or indirectly. So if we just pick a few, randomly select a few big tech and consumer companies, global companies that are listed in the US market, we can see that ranging from 20 to 60% of their revenue generated from China. Volkswagen sells approximately 11 cars a minute in China. So the point here is really the risks associated with China impact our global portfolio just as much as the Chinese domestic companies. So this is something we always should pay attention to, the risks from China, but let's not forget about there's also a lot of opportunity there. So what happened in the last 2 years, as I'm sure like everyone saw the news headlines, especially in Western media, ranging from there were a lot of negative events in the past 2 years, whether it's externally or internally. So focusing on the kind of the internal matters, the biggest concerns often cited by people are the state influence over the economy, geopolitics with US, the real estate, the slowdown in the real estate sector, and the zero COVID policy. Over the past few weeks, we have already seen a lot of positive signs in most of these concerns, and hence a very strong recovery in market performance. On the positive side, we think there's still considerable room for policy easing, as I will talk about the growth opportunity in the green economy, EV, and domestic consumption still will recover very strongly after this current COVID wave. And consumption upgrade will continue to be one of the structural growth drivers in the next decades. And last but not least, valuations are still very attractive. China, unlike the Western markets, China does not have inflation issue. If we look at both CPI and PPI, they're still relatively low compared to the Western world. So it's actually providing a good kind of backdrop for reflationary policy to be implemented by the Chinese government. And there's structural reasons and also cyclical reasons to a low inflation in China. As the economy reopens, we might see inflation to pick up a little bit, but still within the very manageable range set out by the central bank. One of the risks that that the market was concerned about is regulatory clampdown in many of the sectors in China, including the tech sector. As we know, policy cycles happens in every market, but especially for emerging market like China, where there's immature regulatory framework, we can see a more obvious effect. And sometimes the government fails to communicate to the market effectively, so creating a bigger concern by investors, or especially for the foreign investors who don't have the kind of on the ground information. So what we observed in the last 2 years, really, if you look at this cycle, it was really the increase in regulatory scrutiny that started from, the stopping Ant Financial going IPO, and then looking into kind of the anti-competition practices by these big tech companies to the education sector, etc. And we see the slowdown in the economy. And now, after 2 years of policy tightening, we can clearly see the government is back to a pro-growth stance and being more pragmatic, as a lot of these objectives, regulatory objectives, have been achieved over the past 2 years. So now the government is backed on providing stimulus and policy easing to the economy and to the sectors, including the big tech. As we have been seeing positive news coming out in the past few months. More recently, it's rumored about Ant Financial going IPO. There's a timeline for them to go IPO again. There's Alibaba is having a partnership with the local government to support the economy, etc. So there's a lot of positive signs coming out that we believe this round of regulatory tightening has been behind us. Real estate, the real estate sector is also frequently cited in Western media, and we recognize there is a crisis in the private developer sector, but we think the scale of it it's manageable, and we don't think it will create a systematic risk in the Chinese economy. And recently, the Chinese government has been providing a lot of support to this sector, including allowing equity financing for the listed companies, as well as encourage providing more liquidity through the banking channel to allow to make sure that the developers are delivering the incomplete houses to consumers, and making sure that basically putting a floor to the liquidity crisis in the sector. But while it remains some uncertainty whether the physical market, how fast the physical market will recover this year. But we think that there's already a floor to the situation, and the crisis was always limited to the private developers segment. On the other hand, the other part of the market is still doing very well, which is the developer that has government funding, the state-owned enterprises. At the same time, they were picking up market share. They were picking up like distressed projects from the private developers, and we have seen the share price, making new highs, and some of our portfolio managers have been tilting the portfolio towards to that segment of the market. So overall, we think the crisis in the private developer segment will be resolved very quickly. COVID, as you know, that now it's really behind us. It's been over 2.5 years since the pandemic outbreak started. The Chinese government finally in November decided to reopen the economy and putting an end to its zero COVID policy. So it was welcomed by the the global markets, and it was the single biggest event that happened in the last 2 months. As a result of the prolonged pandemic control, we can see that it really hurt consumer confidence, employment, and spending in the economy, especially in the last year in 2022. But we think this is all over, and if we can learn from what we from the developed markets, really after reopening, there will be a strong pickup in consumption due to pent-up demand. So we see consumption growth will probably double-digit growth in 2023. This current COVID wave also happened much faster than a lot of people expected. So I think within just 1.5 months, basically 90% of population in urban areas already, contacted COVID, and they are already, most of them already recovered or in the process of recovering. So we should expect, after the Chinese New Year holiday, which will be next week. So starting in February, we will see kind of life will back to normal. Production will be back to full capacity, and we will see consumption gradually pick up in the next few quarters. And this, yeah, can skip that. So this in the next few slides, we want to remind our investors, there are a lot of growth opportunities in China, and this is why we're investing in this market. On this slide, we see the green economy. We're using electric vehicle as a representative here. China not only dominates the EV supply chain, just like the handset supply chain. China has very good logistics and good manufacturing capability at a large scale. But also, China also enjoys a very strong domestic market in terms on the demand side. This chart shows you the global EV sales that's in thousands of units, break down in major markets. And as you can see that China dominates in terms of, accounts for more than 60% of the global market and still growing at a very rapid pace. The second place will be Europe, and US is really lagging behind. So in terms of like the structural things in the consumption space, we see two themes. One is consumption upgrade. So this chart shows you that some of the premium brand liquor, domestic Chinese brand Chinese liquor, was selling at a very high price, in some of auction Sotheby auctions. One case of Multi was selling for 200,000 to 400,000 pounds. So even like a normal, so this is the vintage type of collection series, but even a normal bottle, like this year's Multi, that's the normal flagship product, would be selling at 3,000 RMB, which is the local currency in China. So that's equivalent to about $500 per bottle for a 500 ml bottle. So that's very expensive in terms of the GDP per capita in China, but the demand is there, and every year it gets sold out every year, and they have to keep increasing the retail prices for this product. So Chinese people are buying, consumers are buying higher end products. They're willing to pay higher price as the GDP, as the income level increases. As we know, in the world of e-commerce, China dominates. This big global companies like Alibaba, like JD.com. But even in that space, there have been new business models coming out, and these new business models are growing rapidly and driving the growth in the overall e-commerce space. This picture here it's basically a snapshot of a live e-commerce. So you have the host in the middle broadcasting in live format. So the host demonstrates and critiques the products, interact with the audience or the people who's watching this show, and then there's this link, and you can buy this product by just clicking into the link, and and you pay. You can basically transact everything online within 10 seconds. It's a rapidly growing model. The top two hosts made $3 billion sales in one single day. In 2021, so that's more than many listed companies, the annual sales in China. Valuations are still very low. This chart, it's a bit outdated. So since then, in the last 2 months, the valuations have picked up a bit, but still below a long-term average. So still very much at a depressed level, especially in consideration of next 2 years growth, which will be much faster than the last 2 years. So this is still a very, very attractive entry point for Chinese equities, especially given the external environment. Also, Fed rate, the coming to an end to the rate high cycle, so liquidity should flow back to the emerging markets, including China.
Okay. Thanks, Robin. I realize we're just about out of time, so let me very, very quickly introduce the fund itself. and then hopefully you guys can take that away and reach out to us with questions if you have. So our fund was launched. So we've had a flagship strategy that's been going for just over 4 years, very successfully. Information ratio of 1, annualized outperformance of 4% over the benchmark. This is the UCITS version of the product, which, as Eugene said, there's a feeder fund that we've launched together with BCI that is available to domestic South African investors. Fund is now actually just a little bit over $15 million. We've had a bit of inflow. I can't say a great deal about performance for compliance reasons, other than that it's been tracking its benchmark and outperforming very slightly. So you can work out returns from there. What is our structure? We have allocation to both the mainland A shares as well as to the offshore shares. Right now, we've had a slight overweight still to the mainland, which is partly where we see the better opportunities. But it is something that we do keep an eye on from a risk management perspective, so as not to be too far away from the benchmark. Sector exposure also reasonably close to the benchmark, with the exception of financials. That's a structural reason, because a large number of financial companies tend to be state-owned enterprises, and they are unattractive for investment purposes. They're not necessarily run with a pure profit motive. Top 10 holdings, again, we can look at that as well. Style and ESG-wise, everything is within sort of 1 or 1.5 standard deviations exposure, so there's nothing much there. Really just to introduce the key people. Faisal Rafi, he's our head of manager research. He sits across the desk from me in the London office. He, together with Robin, are really our key professionals in terms of finding underlying managers for the product. Andrew van Biljon, based in Cape Town, he's the portfolio manager. He actually heads up our multi-manager business. And then these guys are supported by our group CIO, Joe Klansbeck, probably known to many of you. And then a number of people around the world, there's myself included, our colleague Janice from Shanghai, and colleagues in Mauritius, colleagues in London, colleagues in Cape Town. As you can see, we have been shortlisted for various asset management awards in relation to our flagship fund. So there is some external validation that we've got a little bit of skill in the Chinese market. The second last slide is really just, what makes us a bit different is the degree to which those senior people are involved in the actual fund selection, the fund management. We don't outsource that to junior staff who then file reports. Instead, it's our senior guys who are actually on the road. They're meeting managers. They're finding out what the opportunities are, what the tactical balance in the fund should be, and are implementing that. So yeah, really just to conclude, the Chinese market is one of the fastest growing in the world. There is an inflection point. Robin perhaps was not as enthusiastic as I am, but really the fact that we've had this COVID wave, once that's over, there should be a really rapid rebound in economic activity and consumer spending. We've seen it in other countries around the world. When COVID waves were finished, there was generally a very, very sharp snapback. And like I said at the very beginning, the train is about to leave the station. You want to make sure you're on that train. And with that, I'm not sure there is time for questions. Eugene, it's back to you.
Yeah, Lars and Robin, thank you so much for that. I am going to take 1 or 2 questions. I mean, while we're with you, Lars, let's just talk about a little bit more about the fund. I mean, there's definitely growing interest in South Africa and China for all the right reasons that you've mentioned. And I mean, there's limited funds or options in South Africa available. And this is a very good pure Chinese equity fund as a good alternative. And it is multi-managed, but I want to talk a little bit more about that. You've shown your selection or exposure to mainland China A shares and then the Hong Kong H shares, but let's talk about the multi-managed process. How do you go about selecting managers? Who are those managers? And is that the reason why you've got good access to A shares or mainland China?
Let me start with an answer, and I'll hand over to Robin, who of course is much closer to that process. So finding the right managers in China is a little bit different to the way it works in sort of more Western countries. And your main problem is there isn't a nice homogeneous database that you can just go with historical performance. You can screen for. There are obviously cultural and language differences, but those we can address by hiring people in country. But really, the Chinese asset management community hasn't fully embraced foreign investors yet. There are cultural reasons. People don't like giving bad news. They avoid asking questions necessarily. Transparency can be a difficult thing to get hold of. Track records are very short. So actually, in many ways, it's like the emerging asset manager scene in South Africa, where you get a lot of new managers that are formed. They've got short track records. They change roles quickly. Some of them will fold. A lot of it is done by word of mouth, by networking. And so the skills that we've gained by operating in the South African market, we find we can actually port those quite well into China. Robin, is there something else you wanted to say about why multi-manager is important, perhaps, or anything like that?
Yeah, sure. So just to add a little bit to that, I think our edge is, we started early in China. We started research in China back in 2013, 14, and we have accumulated a great network on the ground and with the largest global allocators in the region. So we were able to identify talents earlier than most of our peers. We're trying to stay one step ahead, and there are many new launches in China every year. So we need to map out the whole universe and filter, based on our standards, our criteria, we need to filter it down and do a lot of due diligence to each of the managers, and also monitoring is as equally important as identifying talents. So after your investment, how to monitor these managers, making sure that they're delivering per your expectation, that's very important. So a few words on the multi-manager approach. We think China is given the market it's so big. There's a lot of opportunity. So there are roughly 6,000 listed companies in China. And oftentimes the specialist managers, they run a very concentrated portfolio, just looking at one or two sectors or one or two regions of the country. So they develop, very deep level of understanding of the companies, but at the same time, they want, if you only hiring one manager, you can be running a very high check-in error, and also you are turning away from other opportunities in China. So the approach that we take is we hire multiple managers. We manage the risk at the total portfolio level. We try to build an all-weather strategy that can deliver in different type of market environment, different type of market style. At the same time, the objective is to generate alpha through stock, mostly through stock stock selection. That's the idea. So China is one of the unique markets that when you have more than 5 to 6 managers in the portfolio, but you can be still able to. So as one, you can reduce the check-in error significantly, but that doesn't mean that your alpha or your outperformance it's coming down at the same level. So we managed to maintain a good level of alpha generation while managing risk very tightly.
Yeah. Thank you, Robin. Maybe just one more question. I can really keep you busy here for another half an hour, but unfortunately we're running very short on time. One more question, and it speaks to, why people shied away from China for a very long time. And over the past 2 years, we've seen increased state interference in businesses in China. You just used the gaming sector as a very good example. And now with Xi Jinping as life leader, what can one expect? Are you going to see more state interference in Chinese companies, or where is this going?
Let me start with that one again, and then get Robin to just flesh it out. So, yes, there was a lot of regulatory intervention in the last 18 months. But I think the authorities have recognized that it was too much, too fast, too at the same time, if you will. And they have pedaled back on many of these things. There was sort of a key speech, actually it's almost a year ago now, by who was then the deputy premier, saying going forward, we're going to be more transparent about our regulations, which is, Chinese politicians speak for saying, we understand that this was too much. Going forward, we will be more consultative. We will be, we will involve industry more about what's going on. And then just quickly, the one about the Communist Party and Xi Jinping. Two thoughts of that. I think the Western observers probably had unrealistic expectations of the Communist Party Congress, that it would be a platform for announcing policy, economic policy in particular, which it isn't really. It's a political thing. It's about appointing the right people. Since then, there's been an economic congress that's been much more important for actually the direction of policy. The fact that the party, the Politburo is staffed with loyalists, if anything, it might actually be helpful, because it strengthens the hand of those people on that Politburo, because they're all loyalists. They know they have the chief's backing. There isn't the infighting in the Politburo is less likely, and so it strengthens their hand to actually put things through. And a lot of the members of that were previously the new members at least, were party chiefs for either the big cities like Shanghai or some of the big industrial regions. So they have a track record of successful economic policy. But also, at least one of them was the guy in Shanghai who was responsible for many of the lockdowns. It's not completely all plain sailing, but certainly their hand is arguably strengthened. But we have to wait and see. I don't know, Robin, you probably know a bit more about the people and their impact.
Yeah, so we are quite positive about this new leadership lineup. To share one fact is there's more people with technical background or technical like engineering education in the leadership today versus the kind of the last before, and this is in line with the China's ambition in terms of building its technological independence and building its advanced manufacturing technology. So in general, we think these people have the right skills and experience, like Lars mentioned. They all came from the most open, most dynamic places of China, and given that these people handpicked by President Xi, so the trust is there. So we think that Xi can delegate more of this economic planning, policy making work to these people. And just to add to the first question, really sorry, I lost my mind. It was about what was it about? I trying to recall.
No, that's fine, Robin. I think both you and Lars answered that question very greatly.
Sorry about that. Yeah, I did have a point, but I forgot.
No, that's fine. Not to worry. We're really out of time. Lars, you've done a wonderful job with answering some of those questions in the Q&A. There's still some open questions. We'll circulate those questions through to you for answers, and then we'll send it back to the audience. The session are being recorded. Robin, just from my side, if you have any plans to come to SA, I'm sure there's a lot of people that would actually like to see you. So let us know if you do have plans and if you want to come see our beautiful country. From our side to Lars, Robin, also Christine joining them online, also from London. Thank you so much for your time this morning. To our audience out there, thank you for joining us on the session. Maybe just a very quick reminder, next week, Tuesday, the 24th of January, we have a very special session for you with the one and only Ryk van Niekerk on the SA political landscape. I'm sure all of you want to know more about that. And then obviously, again, Boutiques on Wednesdays, the 25th of January with 361. I'm very excited about this China Fund. It's very difficult to find managers in China. It's exactly what you've said here. Some of the open questions that I actually want to get answered is, what is that right number of managers in the multi-managed portfolios? We will elaborate that. We'll get some of those answers back to you, to our audience out there. the BCI team, and the RisCura team. Thank you so much. Time caught up with us, but we'll keep you informed. We'll chat to you soon, and we'll see you next week, Tuesday. Thank you once again.